I do a lot of videos on Index Universal Life, and one of the questions that comes up in regards to Index Universal Life, or I guess comments, is the topic around increasing death benefit or level death benefit, and the ability to kind of change the death benefit options as you're going through the policy. How does it impact the funding strategy? How does it impact the distribution strategy? Where is the risk in both options? How did each work? How does the option between the different death benefit options, how does it impact the actual performance of the policy? So in this video, we're gonna talk about exactly that. And by the end of this video, you're gonna understand exactly how the option A versus option B death benefit options at all the different periods of the policy come into play for you, where the risks are, and how you can make a better decision around that for yourself. So if you haven't already, make sure you subscribe and hit the bell. That way you're notified every time I launch a new video. Let's go. Hey, what's going on, Cashflow hackers? It's Chris with Life 180, and for this video, we are going to be talking about option A versus option B death benefit, the different ways to transition that death benefit in different times of the policy. How does it really work? Does it work like your agent is telling you it will work? Where are the risks for you as a policyholder? And ultimately, if you watch my channel, you know that I am a big critic, I guess is the word. I'm very skeptical about the marketing behind Index Universal Life because it just typically doesn't ever work the way that agents or companies design illustrations to show it working. And one of the ways that they are able to manipulate the performance is by doing this option A versus option B death benefit on the illustration. Now, a lot of people say that, well, let me do this. I'm gonna go to my board and I have an illustration, but I also wanna do a little kind of like IUL 101 here, talking about what we're talking about. So if you are looking, if you're looking to buy a policy for the first time, I wanna make sure this makes sense. So option A simply means it's a level death benefit. Option B equals an increasing death benefit. Okay, and so that's important to understand. So now I have this illustration. I've done like big reviews on this illustration before. This is the Allianz Pro Plus Advantage. I'm not gonna break down like all the things I think about the illustration as a whole. I just wanna use this as an example to kind of show what is what here. So you can see, this is a poorly designed policy in a lot of ways, but you can see here that you have $15,250 and then the death benefit is $515,250. As the cash value goes up, so does the death benefit. So what you have here is you have a $500,000 death benefit, and you have option B, meaning increasing. That means the death benefit is going to increase by the cash value. Now, why is that important? It's important to understand that Index Universal Life equals annual renewable term, meaning every single year there's an annual renewable term policy that's going in to the policy, and that the amount that you're paying on the annual renewable term is going to be based on the net amount at risk, or NAR. I talk about this a lot. Now, the net amount at risk is the death benefit minus the accumulated value equals net amount at risk. And so you could see here the death benefit is $587,000. The cash accumulated value is $87,263. And so when you look at that, it's $500,000. So we know that every year here with this, because it's an increasing death benefit, this individual is buying an annual renewable term of $500,000. Now, I don't have an example of what that looks like, but another option and another way this could have been done, well, and I guess before I get into there, the question is, why do they do this? Because when you do an option B, you are able to fund more money into the policy without mecking the contract, right? So it shows you the ability to fund at a higher cash value rate, or like you're able to jam more money into this policy. And it is what it is. So when people are trying to do max cash value designs for a policy, option B is really the only way to go, because the other way to do is option A. So if you do option A, what would happen is you would say 500,000 would be the death benefit. And as the cash value increased, let's say right now there was 15,250 of cash value, what would happen is this 500,000 would remain level. So now we would be talking about, instead of 500,000 plus the 15,250, we'd be 500,000 minus the 15,250, which we would end up with 484,750. Now the net amount at risk is actually 484,000. So the idea here is saying, all right, the cost of insurance is based on this number. So your premiums are based on this number. Now, in this policy specifically, once again, I told you I wasn't going to get into the specific designs. It's a pretty poor design, because you could see they stopped funding at 164 at year 10, but they actually did the increasing death benefit option until, like, I think age 54, which, whatever. I suppose it gives the flexibility. These are my notes from before. It doesn't really matter. I'm going to just ignore this. This is just from the last video I did. The purpose of this, once again, that element of this is inconsequential as far as what I'm trying to show you. The important part here, though, is talking about in retirement, when they start doing this. Now they did a level, because you could see the challenges in this. They increased it to the death benefit kept going up and up and up based on the cash value going up. And so even though that was going up because it was going up due to the premiums being paid kind of inside the policy. So here's the idea, and I'm just going to use this to get some random numbers. So let's say here, the person, by the time they're 57, I'm not going to worry about their income right here, because it's, once again, inconsequential. You can see by 57, they had $1 million in the policy. This is the accumulated value. And that is what it is. So let's just assume they didn't start taking money out of there. So until then, so let's just assume a 60-year-old has $1 million in the policy of accumulated value. And let's say that they did the option B, and that was a $500,000 death benefit. So what's going to happen here, if you looked at an illustration, you'd have $1 million accumulated value. You have the $500,000 initial death benefit. So what's going to happen is you're going to have $1,500,000 of death benefit. And that, because you got the accumulated, or the death benefit minus the accumulated value, is going to be the option B, which is the increasing. That's going to go up. Now, the idea here would be to say, all right, at 60, if you want to trigger income, they would say, we would switch to option B. Why are we doing this? Well, we're doing this because we want to make it so as the $1 million continues to grow, we want to make sure that this $500,000 starts to shrink. So we don't want this. Basically, what would happen if we switched and the death benefit at that point in time was $1.5 million, as soon as we switched at that point in time, this death benefit would remain where it is. We would and what would happen is, as the $1 million grew, it would eat into this number, and that would reduce the net amount at risk, would be reduced by switching to the level, or switch to option A, I'm sorry. If you go to, I just realized I did that. That was a total, I was just thinking ahead. You're switching to option A from option B in retirement. So you would switch to option A. The net amount at risk would then be eaten into as the accumulated value goes up in the policy. Here's the problem when we do this. Theoretically, mathematically, on an illustration, it's going to work. Why does it work? Because it shows perpetual growth with this $1 million. The hard part with an IUL is that it never shows negative years. The challenge is, as soon as you start taking income, and in this illustration it's not going to work so well, but let's just say out of this, it's not uncommon to show about a 10% distribution. So let's just work with round numbers here. So let's just say that the policy shows 100,000 per year income. So, and you're paying 5% loan, okay? What's gonna happen is you're gonna take that 100,000, but you're gonna owe the 5,000 in interest. And then the next year, year one, year two, you're gonna take another 100,000, and you're gonna have the 5,000 in interest, or 5% interest on 205,000, because you gotta add this, because you're not ever paying back the loan, because it's tax-free income in retirement. And so if you had the money to pay back, you wouldn't be taking the income. And so the challenge is this 5% compounds against you in retirement income. And the reality is, as you go through this, you're five years in, you've taken $500,000 of income, but you owe, let's just call it 540 to 550. I haven't done the exact numbers, but that's what you owe at that point in time. And so this is going to be what your interest expense is based on. Now, why do I bring that up? Because when you switch to option A, all is fine if you utilize, if the market is going up, all is well. That's the bottom line. As long as the market is perpetually going up, all is well. The challenge is, as soon as the market goes down, when you're taking loans and your leverage, you still have this risk that's injected in there. Now, here's the next problem. A lot of people, I guess let me elaborate on this, because when we're talking about taking loans out against this policy, and I'm gonna just do this here just to show kind of an example of how the policy performs, because these guys switched the option when they started taking income. I think they should have started switching it to a level back when they stopped funding the policy, but that's kind of inconsequential for this conversation. The good news is it was switched by the time they started taking income, and so that's a good thing, for the sake of this conversation, because it allows us to have this kind of apples to apples conversation. So you could see, and I'm going to highlight some stuff here. You can see that the accumulated value by the time they got to the last year before they started taking income was 687. And when they started taking the funding with the growth and everything, well, you could see that the death benefit was 1,312,000. And so that is what it is. It's there. But now we start taking income, and you could see the cash value goes down, the net amount at risk, the death benefit goes down. But when we minus out, let me do the math here. Let me just get my calculator and run some numbers. All right, so when we're running these numbers, if we look at this is kind of what we have to look at. We got 1 million. I'm just going to write this out here. We got $1,312,413. Okay, this is remember, it's the death benefit minus the cash value, which is this column, not the accumulated value, but the cash value. That is the net amount at risk. And I think that is really, really important to understand, because when you have that risk, that net amount at risk is absolutely real based on where the exposure is to the life insurance company. So the cash value at 687 and 127, and when we go 1,312,413 minus 687, 127 is 625,286. Okay, so this is your net amount at risk. Now, on the illustration, it looks really good because they've got a level death benefit, and now they're taking income. Let's think about how this is functioning the next year. You're taking the income, okay? And the accumulated value is going up, but look at the cash value, it's going down. The death benefit is also going down because it's a level death benefit. Cash value's gone down, but here's the deal. You could see, even though those two things are in place, we got 1,263,072. So 1,263,072 minus the 646, 086, 646, 086, and we're talking 616,986. So now you can see here, even taking the income, because we had positive arbitrage in this equation, taking that income is going to go into a situation where the net amount at risk here has gone down, right? So the idea and why this works, because you did a level death benefit, is it shows even with income, because of the fact that there's 50 basis points of positive arbitrage, it's going to show this work really well, and the net amount at risk is going to go down and down and down every year. On an illustration, it works. The reality is it doesn't, because of the fact that life doesn't exist on a spreadsheet. And here's what happens. Now what happens is, like, you've got all this income. Now we're going to get away from the actual illustration. I just want to show you that that's kind of how it works. It doesn't really matter the specific illustration, but when you go a level death benefit, this is how it goes. And so now we owe this 550,000 5 years into the retirement income, right? And so now what do we have? Now we have, well, actually, here's what I do want to show you. I want to show you what's important to understand is that in this scenario, that the cash value, you can see here, the cash value is going down and down and down. Why? Because of the loans. The net amount at risk is going down, and so the costs, are under control in the policy, but the cash value is going down. And it's really important to understand this, because in this scenario, I think it's, as we go over here, what's going to happen is, let's just kind of drop a hypothetical, because I want to keep numbers really round so you understand it. So remember, you hit 60 years old, you have $1 million of cash value, you have a death benefit, so then you have a loan amount, and we're going to say 0 right here, because we're going to pretend we take income at 61. So, and then we have a death benefit, and the death benefit is $1,500,000. And so what's going to happen though is that because we're taking this loan and we expect positive arbitrage and all these different things, what's going to happen is this cash value, and I guess there'd be an accumulated value over here as well, but we're going to just focus on the cash value. We're going to take the income, let's say, of $100,000. So the cash value is going to drop by about 50,000, because if it's assuming 50 basis points of positive arbitrage, actually it's about 5,000. So the cash value is going to drop by about 95,000 because we're taking 100, and it's going to grow. So here, let me explain how that works. This is why I'm saying this is always sold as a simplistic product. That's a very complicated product. So it's saying the $1 million is going to grow by 5.5%, and we're going to borrow 100,000 at 5%. Right, and so what's saying is the 100,000 of this, when you borrow against the policy, it's going to be earning. You're paying 5%, but that 100,000 is going to be growing at 5.5%. So you're going to have 50 basis points of positive arbitrage on this. The rest of it's just going to do what it's going to do. And so at the end of the day, it's going to reduce your cash value, but it's not going to reduce it by the full amount, because you're going to have that positive growth in the policy. So we probably have 910,000 of cash value. And I want to show this over here, right here, because you could see that the cash value right here was, let me erase it so you could see a little better here. The cash value right here was 687, and then they took 77,000 of income, and it only dropped by 30 something thousand, right? Almost 40,000. It did that because of the fact that there's positive arbitrage. So that positive arbitrage is what made it so it didn't make the cash value drop by all $77,600. So we're going to go and apply that same principle over here. And in fact, let's do a little bit of a different, I'll make it a little better. We'll say that over here, and I'm sorry this is so technical, but let's just say it's 950. Let's just account for half of it. Because once again, I'm trying to talk a principle here. So what would happen here is this would drop to like, well, let's look at the ratios here. The death benefit dropped by about what the cash value dropped. So let's just drop the death benefit to 1,450,000, right? And the loan amount here is going to be 105,000 because it's the loan amount plus the interest that you owed on it. If you took the loan at the beginning of the year, that's the way it works. So then at 62, we're going to do the same thing. We're going to take the 100,000 of income. It's going to drop to about 900, right? And then this is going to be I'm just going to write 210 and not have it compound, but this would drop to 1.4, right? And so you get the concept. We're going down here. Let's say we hit 65 or 66 and we've got $100,000 or $500,000 in loans. We have a net cash value of 750,000-ish. We have a loan amount of about like 550K and the death benefit's only about $1 million, right? That's about what it would be, ballpark, right? Like if we, maybe 1.2, something of that nature. But this is the idea. So why does the death benefit being switched to option A in retirement while we're doing this not work? It's because at the end of the day, what's gonna happen is we're gonna have this scenario happen where we're taking this income, we're gonna owe this 540,000 right here. And then what's gonna happen is we're gonna get a 0 year in retirement, meaning the index is not going to do well, and our call options are going to lose, and this 5% expense is going to be injected into the policy, and all of these numbers are going to get just absolutely throttled and thrown out of whack. And what do I mean by that? So at this point in time, option A is not going to help you because it's the loan risks and the loan charges that come into play, which, by the way, I'm going to answer another question because a lot of people are going to say, well, I could just do a wash loan and reduce this risk. Well, I got news for you. If you did a wash loan, none of this illustration will work. If you did a wash loan, none of this works because this is all based on the fact that the cash value and the net amount at risk is based on the positive arbitrage, and this cash value number right here not going down by the equivalent of the 77,676 in this situation. The fact that the cash value goes down by less right here, the fact that these cash values are going down by less than the $100,000 of income is based on that positive arbitrage, which makes it look like the performance of the policy is actually doing better than it is, when in reality, it's not. So now here's what happens. We have a 0 year. And so at 67, we have a 0 year. Well, guess what? We still want to take our $100,000 of income because let's face it, we got to live. That's why we got this policy. A lot of people, have responded to the full video that I did on the other one and said, oh, well, if it showed 77,000 of income, you don't have to take that income every year. Well, for people that I know that buy these policies typically, they pretty much need that income. And they're buying this because they're relying on that income in retirement. And to say that, I would say this to you. If you're designing these policies for people and saying, hey, just go get your policy and then in retirement, we'll be able to manage your cash flow from it. And some years you're going to just take less. Well, I'm willing to bet you that this is probably going to lose its appeal to people if they think there's any chance that they're not going to be able to take the income that they thought they'd be able to have, right? Because that's the purpose of buying this. To think that you're going to control the fees and the runaway costs and all this stuff by actually utilizing the policy for less than you expected to have to use it for, to me it's just bad thinking in general. And so anyway, we go here, we're taking the 100,000 of income. Let's say the cash value drops to, well, here's the deal, because remember, these numbers are all assuming positive arbitrage. That's why these numbers have not dropped by a full 500,000. So now from 66 to 67, at age 67, we take our cash value is at 700 and we take the 100,000 as income, and that looks good. And it seems okay. But what do we have here? We have 100,000 of income, and so it goes down to 650 because there is no positive arbitrage. So the cash value drops to 650. But here's the deal: this 5%, we now owe 650, or we now have a loan, and the loan goes from 550 to 650. So it's just a coincidence; those are the same numbers. And now we owe 5% on this. Why do we owe 5% on this? Because there is no positive arbitrage. And usually this 5% is managed by the growth of this policy, even after everything's said and done. But now that we have a 0% year in retirement, this $650,000 has to pay for this 5% expense. Well, 5% on 650 is what, 37,500. So this is actually going to go down to 617. I'll just keep it kind of simple, keep it round. And so that is going to actually reduce. And so that is a $30-something thousand. That's equivalent of a 5% loss in this cash value in retirement. And what does that do? The net amount at risk doesn't go down. The death benefit is not going to shrink because we don't have growth in the policy to eat into this, right? Like the only time your net amount at risk shrinks is when the growth in the policy eats into that number and compresses that net amount at risk and shrinks the death benefit. When we have losses in the policy and the policy can't sustain itself and there's not perpetual growth, that's shown on this illustration right here. When we don't have this perpetual growth, which let's face it, the reality in retirement, 25% plus of your years are going to be negative. And this is just, when the reason I say that is because if we have a 5% loan cost, 25% to actually it's closer to 30% of years in the S&P 500 in markets, 25+% of the years are going to perform worse than your actual cost of money. That's why all this perpetual growth assumption in the policy, we should be looking more like 30% of the years. And this is just to be average, by the way. 30% of the years we should be accounting for negative performance, which would be more like this year. So even with option A, the challenge is it doesn't solve the problem. And if we go with a wash loan, which is going to be what the next counter argument by an IUL agent is, if you go with a wash loan, it doesn't allow, it would reduce the the cash value available because you don't have that arbitrage right here showing how it really works. And so therefore, your net amount at risk is not going to go down either with a wash loan. And so as you get older, because of the fact that it's annual renewable term, as you get older and you get to 75 and then 80, like this annual renewable term being more expensive, the cost of insurance goes through the roof. The cost of insurance is based on your age and the amount of insurance. It's going to be a single year cost of term insurance based on your age and the net amount at risk right there. And so listen, no matter how you slice it, a lot of agents will try to tell you that you can control it with option A, switching from option B to option A in retirement, and then you can control it by using wash loans if you decide that you don't want to take the risk. Well, no matter what, there's risks when it comes to leveraging and utilizing an IUL for tax-free income. And that's the problem. That's why I'm so adamant about people understanding what they're getting their money into here. Because listen, this is not simple, right? I mean, I understand this stuff inside out. And just writing this out and getting people to understand it and trying to break it down into simple terms, it's not the easiest thing in the world to do because there's a lot of math and a lot of complications and a lot of moving parts. And when you change one thing, another thing changes. And the challenge that I have with a lot of these IUL agents out here that are selling these things is they go, oh, well, if you don't like this or you don't like that risk, you could just do to solve that risk. And then they don't talk about if you make this shift, i.e. go into wash loans, they don't talk about the risks that get injected once you shift to wash loans. And the risks that exist when you do a wash loan is different. It's a risk that didn't even exist when you had an indexed or participating loan, right? And so there are all these moving parts and all the variables that change when you have a policy. And so here's what I would say. If you're looking at an IUL, I would say run the illustration based on how you want to see it. Because what happens is, as you run illustrations with certain assumptions, based on what I'm showing, for example, if you wanted to show a wash loan, ask them to run it with a wash loan, because it's going to put different disclaimers and different verbiage on the illustration that doesn't exist, that they're not legally or obligated to show you unless you show it with a wash loan. Same with an index loan. Have them run it for you, showing all the different options. And then you can kind of cross-reference and cross-check and kind of see the differences in the numbers. And you can, like, I just did it by hand because I've done this so many times and I understand how it's going to work. But if you want to really understand what you're buying, say, all right, show me the accumulation, show me lower assumptions on the actual performance of the policy, because it's probably not going to perform as well as you think it's going to perform anyway in the accumulation phase of your policy. That's why I created the IUL challenge, just to kind of prove that point. But then also show, all right, when I take income, first of all, force them to show you an illustration taking income, because that's going to add all sorts of disclosures, disclaimers, and detail to the illustration that wouldn't exist otherwise. But then when you have them run the illustration with income, have them run it with the index or participating loan option, and then have them run it with a wash loan option, and see how it changes the actual performance of the illustration. And I think it will blow your mind. And so, and as always, if you have any questions, you can always email us and send me, Chris at Life180, send me a copy of your illustrations. I'm happy to take a look at it. I'm happy to have my team take a look at it and break it down and kind of show you what your options are on how you can manage it. This is one of the reasons, like this, my biggest problem with IUL is it's a very complicated product, full with a lot more risk and a lot more danger than people that people understand. And it's sold as a very simplistic, simple, safe product that's going to help people be a tax-free income source. That's a great alternative to 401ks, when really nothing could be further from the truth. I'm not saying IUL is all horrible. The way it's sold is horrible, and that's my challenge. And unfortunately, we've got hundreds of thousands of agents out there that are doing this, and to me, the ramifications are catastrophic for the industry and for other people that are trying to do it right. Because when regulators look at this, and they are looking at it, and there have been 3 major regulation overhauls to IUL, and these companies and the agents, they keep getting around it, and they keep just selling with these different tactics of manipulating the illustrations and the way they work, when in fact they actually don't perform in real life that way. That's what AG 49 was about, AG 49A, and now AG 49B update in May of 2023. My concern is eventually they're going to say, all right, enough's enough. No matter how much we change the regulations, you guys keep like just finagling the system and getting around the system. So we're going to create an overhaul that doesn't just impact IUL, but it impacts the entire industry, including whole life, which if you do the right way is everything that they say IUL is. And honestly, they steal a lot of the credibility that whole life built over 180 years, and they try to like take that as IUL success, when IUL is actually still just a financial experiment. And so anyway, there's a lot. I'm going on a ramble now. I'm starting to rant because it's just what I do when I get on this topic, because there's so much more to it. And every time I go deeper, I just start thinking about more things. So I'm going to end this video here before I do a full-fledged video on other elements of what IULs are all about. But hopefully now you understand the difference between option A and option B, understanding how wash loans versus index or participating loans impact everything, and how those two features play together. And if you have any questions, feel free to reach out. Chris at Life180. Go down and link in the description below. Set up a time with one of my one of the team members on my team. Set up a clarity call. We are here to help. That's all I can say. So till next time, have a blessed, inspirational day. Take care.